The asset test ratio is the second liquidity ratio we will look at. This ratio is stricter than the current ratio in that only more liquid assets are used to cover the current liabilities. Specifically, it uses cash and cash equivalent, short-term investment and short-term receivable to meet the current liabilities. So what is different from the current ratio? There are some current assets that are either not convertible to cash, such as prepayment mentioned before, or are either dependent on other factors to turn into cash, such as the state of economy and selling inventory. Since the asset test ratio is stricter than the current ratio, you have more flexibility to meet your short-term obligations if you have a strong result in comparison to an equivalent current ratio. In other words, it's meant to be a tougher test, and if the business passes the tougher test, then in theory you can sleep a little easier at night. Now with the formula, so to calculate the asset test ratio, you have firstly to calculate the cash and cash equivalent plus the short-term investment plus the current receivable and divide all the result by the current liability. We have an example. So for the cash and cash equivalent, we have $215,000. The short-term investments, we have $19,000, $414,000 for current receivables, and $1,215,000 for current liabilities. As you see the calculation, we'll have an asset test ratio of 0.64%. So now what this number means? Similar to the current ratio, if you have an asset test ratio of 1.64%, this means that for each dollar of short-term debts, you have liquid assets to meet this debt 1.64 times. And now what it means if the asset test ratio changes. So the asset test ratio suffers from similar drawbacks to some liquidity ratios, but ultimately this ratio should not be used to draw wide conclusions about overall success or efficiency of an organization. It is simply a pure measure of a business ability to meet its debts when they fall due in the near term. Using this motif alone, what does it mean if the ratio changes? So in theory, if the ratio increases over time, then you have a financially stronger business, since the only reason a company will be forced out of business is its inability to pay its debts when they fall due. An increasingly higher asset test ratio can be extrapolated to mean there is less chance the business will collapse due to insolvency. So a high or higher asset test ratio may also mean that a business can continue to run without drastic changes, interruptions, or changes in strategy. In other words, a low or fallen asset test ratio does not mean certain doom for a standard business, but what it means is that its manager may have to spend time, effort, and possibly cash restructuring, recapitalizing, or otherwise improving the liquidity and the balance sheet of the business so it can meet its short-term debts and try selling long-time assets for cash, or increase cash through an equity capital raising and therefore diluting stockholders who do not participate, or forcing those who do participate to front up more cash. Let's go now with the drawbacks of the asset test ratio. So liquidity ratios are just that. They measure the ability of a business to meet its financial obligations. This is also where a problem in this ratio lies. Business decisions that are good for the asset test ratio may not necessarily be good for the business. The asset test ratio is a good measure for the risk of an investment, but what about the other side, the reward of an investment? Bookstores are full of business persons' biographies and autobiographies that many tell about a critical decision where everything was put on the table for a new business strategy only to have it turn up to ramps and ends up making the business person a legend and a big pile of cash for the aforementioned business person. So okay, that analogy is a little fanciful, but on the other end of an extreme, having a balance sheet completely in high liquid, low return assets may be great for the asset test ratio, but not better than plotting the money in an interest-bearing bank account. Few great successes come about by simply putting money in the bank.